Well, let's talk more about all of this. Joining us now is JPMorgan's Marko Kolanovic, and he has got one heck of a report out. By the way, it came out, I think, yesterday. Marko, good to see you. Welcome back.
Thank you.
I was highlighting stuff on the report, then I realized I basically highlighted the entire report because there's so much in here that I think is important to our viewers and our audience. First, let's talk about sort of what we just talked about. You note the ratio of the S&P 500 technology sector to energy is the same as it was or higher than the peak of the tech bubble in the late 90s. But is that alone a warning sign?
Not alone. That's just one of the signs. Actually, we focused a bit more on what you guys mentioned, utilities and some of these bond proxies. So we call them low volatility stocks. So those are stocks that have very low volatility. They act as a bonds, and they typically have a pretty decent yield or comparable yield to bonds. So these low volatility stocks were bid up massively. Along them also momentum stocks, and these momentum stocks tend to have some bias towards sectors such as tech. And Karen mentioned, some of the popular names that we're seeing over the last few weeks really kind of taking off parabolic. So it's basically valuations are stretched both in these defensives and also in these
dangerously stretched. Is the market vulnerable to a significant pullback?
So broad market. Probably not too significant pullback, but some of these factors and some of these market segments, likely yes. So I wouldn't say that they'll take down an entire market. But could we have for instance, pullback in some of these defensives? If we do have some positive news from China, I think these will pull sharply. Or conversely, if you have some negative news, you'll see some of these tech and growth stocks pull back, like we saw today around 11:30. So I think they're vulnerable. Now, if you look at the other side of the market, the other side of that trade is what we call value stocks and cyclical stocks. And they're really beaten down sort of to such a low level that's very hard for me to see them being taken down even a lot more. Now, we talked about that in December.
Like what? What's down? I can't find anything that's down.
Energy's down, like materials are down.
Energy's it. That's pretty much it, though.
Metals and mining, the non-precious metals, industrial metals, So, and certainly others are down relative to the rest of the market, So they're lagging significantly, So the bottom line, we think sort of what should happen, or what we believe is going to happen, is going to be a rotation out of these defensives into a bit more cyclicals, and if there's a broad market sell-off, probably then some of the growth momentum stocks actually catch up on the downside with some of the beaten down cyclicals and value stocks.
So are you saying that convergence would happen in an up market or a down market, either way?
So we think it happened in both. So our core view, our sort of base case scenario is that market still does well this year, and that economy does well, and that we sort of recover from this situation was happening in China. So in that case, we are sort of, our base case view is that cyclicals and value catch up. Now, if there is a sort of, obviously there is a risk that this thing in China spreads out and lasts longer, then we think you would see the catching down from sort of momentum and growth stocks.
Have we ever seen a period towards the end of a cycle where stuff like utilities and REITs trade the valuations that they have? And does that mean maybe they won't be leadership in the next downturn? We typically count on these stocks and these groups to provide some defense in those markets.
Yeah, hard to see them being a sort of providing a hedge or in a down market. And they're tied really to yields, and yields are tied to central bank actions. And broadly across the world, we have on average negative rates, and these stocks are sort of a bit up to a level that we would call basically borderline bubble. So basically, if we look at the low vol stocks, sector neutral, so I don't want to single just utilities, but the lowest vol stocks in each sector, the valuation of these stocks relative to so-called value stocks is actually twice as wide as it was during the '99 tech bubble. So it is a bubble in a way.
So what's the hedge in the next downturn?
It's hard to say. I mean, always the most straightforward hedge is to buy puts, on broad market or to buy VIX. A little bit sort of bizarrely, we think if investors can move a bit of portfolio towards value. We think it could potentially be hedge as well. So again,
buy oil and gas stocks.
Well, I wouldn't say necessarily oil and gas, but generally tilt a bit more towards value, whereby you can limit some of the downside if some of these high flyers actually come down crashing. Or conversely, if we do have a catch-up on the upside, you'll actually participate a bit more. And it is, if you tilt it sell off, you'll compensate that by value stock rallying. So again, the most straightforward would be just a simple hedging. S&P puts, VIX calls, or puts on specific stocks that you have. We do also like a bit diversification, kind of move away from these things that are super expensive, so you may mitigate some of the pain if this bubble is to burst.
So Marko, we're talking about, you're talking about granular, how people are expressing trades and asset allocation. From the market's perspective, just thinking about how bad news is largely being treated as good news. Guy and I often talk about that Stairway to Heaven is the most underrated, overrated song. And I bring that up because in the same way, if you think about the market is not even listening to some very big macro events out there, whether it was the trade war, whether it's the coronavirus. And I'd be the first to say I think coronavirus is temporary and transient, except for the fact that we were going through a year ago, we were talking about many were recession in the context of a recovery that was still very immature. Isn't this enough? The market rallies above where it should be when there's negative news that doesn't look to be as bad. And therefore, you end up with a market that almost has negative catalysts to going higher, if that makes sense.
I mean, I would agree again for sort of momentum stocks, growth stocks, and these defensives. So if you look at the tech names, they're just going up no matter what. Pretty much similar with utilities and some of the defensive. But if you look at the, I'm not going to sort of sound like a broken record, but aluminum, copper, oil, it's down a lot. Even year to date is down probably 20-30%. So I think these sectors are taking the brunt, and the rest is marching, and it makes us less nervous. In both, if there is a quick recovery in China or quicker recovery in China, you'll see the snapback of value and cyclical stock up. Or if there is none, at some point, we'll see the rollover from these high flyers.
Marko, at some point. I mean, I think that's kind of the key. But for now, I think, Tim, the song remains the same.
I knew you're going to do something there.
Thank you very much. Appreciate it.
Thank you.
So, I mean, listen, I think Marko's, if you, by the way, you should, I don't know if everybody can just get Marko's research, but I mean, the stuff that he's writing in here, I think is really worth a read. Even if you're not out there, Guy, and saying imminent collapse, the market's on shaky, these stocks like Tesla that are going up for no reason. I think it's appropriate to take a little bit of caution here.
You have to listen, I agree. It's easy to stay within your dogma and read and listen to things that reinforce your belief system. I get it. But every once in a while, you start to hear and read the other story, despite the fact that the market goes up regardless. I clearly have a bustle in my hedgerow given these moves in yields.
Don't be alarmed at, though.
But exactly. Yeah. Don't be. It's right. I'm not alarmed. But I will tell you, there is a point of diminishing marginal returns in terms of the way the 10-year goes, and we're precariously close to it, I believe.